I think it's a very common question that gets asked because I see it in the Facebook group pages all the time. Hey, are you guys locking this week? Or are you floating this week? Are you locking today? Or you're floating today? Like when somebody reaches out to you, Owen, how do you answer that?
Boy,
Wait,
that's
wait,
a
wait,
great
wait, wait,
question.
and wait, and let me do it two phases. So number one,
Okay.
what do you tell loan officers when they ask you?
Mm-hmm.
And number two, what do you tell prospective, you know, prospects
Borrowers.
if it,
Sure.
if it, if it's any different? So, which one you want to do first, the borrower or the loan officer?
Well, we can do them. We could do them separately, and I'm good with either. It's pretty the same information with a slightly different presentation.
Okay.
Um, I when I was writing loans, and why don't we take the borrower first? And when someone would ask me whether or not they should lock, I would give them the information, and then I would always encourage them to lock. I would say, look, and I would kind of make a joke of it. I said, if I knew exactly what the fight, because they always ask, are they going up? Are they going down? What do you think? What do you hear? I heard the Federal Reserve's going to do X, Y, and Z, whatever. And I would always say to them, hey, if I knew what the financial markets were going to do ahead of the financial markets actually doing it, I wouldn't be a loan officer. I would be doing something else. And then that would get them to laugh a little bit and it would disarm them. And I would say, when the market moves, it usually moves down, meaning interest rates go up, right? Because the markets move inverse.
Yeah.
So it usually moves down and interest rates go up faster than the market improves and interest rates go down. So just on a straight line, statistically speaking, you're more likely to be harmed a larger amount than you are to be helped a larger amount.
Hmm.
And then I would say, I'm not a gambler. And so my inclination would be to lock you right now. And if the market moves a very significant amount, a quarter or 3/8, we can have a conversation about me helping you do a little bit better. But you'll be protected from the downside.
Yeah.
And one thing I would add to kind of update that to today's market is my guess is everybody listening here is real similar to the pipeline that we have, Carl, you and I together, that a very meaningful percentage of those loans are just making it to the finish line, right? They just have enough money to handle the down payment. Because remember, you got to move too, right? Whether you're hiring a moving company, whether you're renting a truck, whether you're paying your brother-in-law, right? Every move, I always joke with my wife, means 5 or 6 trips to Home Depot or Lowe's or, just for stuff. And it seems like each one of those trips is $400 or $500. And so, I would, with such a meaningful percentage of the pipeline barely getting to the closing table, I would really urge them to lock. And I would say to them and to Mr. and Mrs. Borrower, remember, our closing numbers are pretty tight, and we just had to justify that you have enough money to close. If the market goes north instead of south, and your interest rate goes up, or more likely, you're going to have to bring 40 or 60 or 70 basis points more to the closing table, you may not qualify.
Hmm.
But I know I can get you qualified here. So I would always urge them to take the sure thing, because when and I'm not saying that if the market, goes up, which again, inversely means interest rates go down, that they're not going to call you and say, hey, I read an article, or my next door neighbor said he got 5.99 and I'm sitting here at 6 1/8. I get that. But in my book, that was always a much easier call to handle than the call about you no longer qualify, or the call about I know you were at 6, now you're at 6.25, or you can bring an extra 88 basis points to the closing table. So I was always in the camp of take the sure thing. I often joke. I mean, when loan officers ask me the question, I often ask them, do you want to gamble with your commission pipeline?
Mm.
Because again, I'm not a gambler, but I know that if you go to the casino, right, they give you those free shrimp for gambling, the big ones,
Yeah.
But if you gamble your commission pipeline, you don't get any free shrimp.
No.
So I would always urge people to lock. It's just my bias.
Yeah, and I know I try not to put a timestamp on the podcast episodes so that it's
Mm-hmm.
something that if somebody listens to 6 months from now still gets value from it. But
Right.
I'm gonna risk that just for a second. So here, not too long ago, the Feds decreased the rate, and of
Yep.
course, it was pretty much already built into our rates, but there was
It
a,
was.
a little bit
Yep.
of a decrease, right? And then, like, for to the layperson, no apparent reason, rates pop back up a bump, right? So
That's right.
it was kind of
That's
like
right.
down 2 steps, up one, right? So it
That's
was
right.
lower than it was, but not as low as it was last week. And I heard a lot of loan officers saying, "Oh my gosh, I was floating all these people, and now I got to call them up and say, oh, by the way, you thought your payment was this. Come to find out, it's not. Now it's that." And like you said, some
Mm-hmm.
of them on the debt to income ratio were right on the bubble, like they were good, but just right on the bubble. Now they got a problem. And so I've always
Yeah.
I take I really like what you said. It's and just kind of in summarizing it, when you were talking in my head, I was thinking if I'm talking to the borrower, whoever he or she may be,
Mm-hmm.
is to say, like, look, if rates, like, if we float and rates go down, you're happy on a scale of 1 to 10 about a 6, right? So we're
Mm-hmm.
floating, rates go down, you're happy about a 6. If we float and rates go up, you're like angry at like a 10.
That's right.
And
And just thinking selfishly for a second, right? Because I know that a majority of the people that listen to the podcast, are self-sourced retail loan officers.
yeah,
Selfishly, do you want one of the um, a bad taste in the mouth of your borrower, someone
mm,
that you're going to try and keep in your sphere of influence for years and years and years?
yeah,
Do you want um, that person to have a negative experience that close to the closing table? I mean, think about this, Carl. I got an email, right, from a friend of mine yesterday, and I don't write loans on a day-to-day basis anymore, but
well, and just
called me.
I don't want
Go
you to lose
ahead.
your thought, but just I don't think I did that. So I'm talking with Owen Lee. He's the owner of Success Mortgage Partners, which
Okay.
closes hundreds and hundreds and hundreds of loans per month. So it just when you said back when I was originating, I didn't want anybody to think that you were out of the business. Like
No, no.
that you're in the business, you own the business. And so anyway,
As
I just wanted to
yeah, as
I
you
wanted
know,
to
I have
clarify
I
that
have both feet, both hips, my
you're
rear end, and
you're
I'm
all
I'm
in.
in the business up
Yeah,
to my nostrils.
yeah, you're all in.
And I talk to loan officers, and a fair amount of borrowers. Well, I talk to loan officers multiple times every single day. I talk to borrowers at least weekly.
Yeah.
Um, but I had a friend who emailed me and said, "Hey, I didn't go with your company. I'm really upset. I bought a house a year ago, and now my escrow has been rejiggered, and my payment went up $500 a month." Now, of course, the college friend is no longer in the business because it got hard and the college friend got out, and his so-called friend never told them that when property transfers, we're in the state of Michigan, this borrower, when property transfers, property taxes are capped until that gone up. So anyone who's in the industry with a functioning brain should have been able to predict what his payment was going to go to. Anyway, my point of all this is negative experience at the end or after the closing. If the market goes the wrong way and you have to call and say, hey, it's an extra 46 basis points on your $450,000 loan, so you have to come to the closing table with an extra $2,300 or whatever the math exactly works out to, that's a negative experience that they have right at the closing table. And I guarantee you, a year from now, 2 years from now, 3 years from now, when they remember the closing, they're not going to say, oh, Carl wanted me to lock, but I read an article in the New York Times that morning saying interest rates might go down, so I made the independent decision not to lock. They're going to go, that Carl's a nice guy, but he kind of screwed me at the end for an extra $2,300.
Yeah.
So also selfishly, lock in the good experience, prevent yourself from having to make that phone call. And listen, with all due respect to the market watches and the Barry Habibs and I watched the bond market show on Bloomberg, and we're all armchair quarterbacks when it comes to this stuff.
Yeah.
We really don't know. Someone sneezes in the Far East and the Bank of Japan says X instead of Y, and all of a sudden you're out 29 basis points. It seems a poor bet to me. And so I would always try and lock the people in, lock in a good experience. And like I said, I'm not trying. Well, let me get back to one other point that I was going to make earlier. You alluded to the time frame that we're in. As we're recording this, it's the fall of 2024. The Federal Reserve a few weeks ago lowered interest rates by 50 basis points for the first time since literally 15 days to slow the spread, since March. We all remember that, right? 15 days to slow the spread. And so they just lowered it 50 basis points, and everyone had anticipation that it's going to come down further. And a lot of the talking heads of our industry were predicting more and more. Well, interest rates came down a fair amount. And but what happened is then we got a good jobs report. And then we got what was a fairly tame inflation report year over year, 2.4%, right where the Fed wants it. But it was 1/10 higher than what the experts were predicting. And I get why the experts freak out about a 10th, because a 10th extrapolated over 12 months is 1.2%, which does make a big difference. But how do you predict inside of a 10th, right? And so the market moves in front of the Fed's actual movements, probably by 2 to 4 months. And there were further cuts priced in that became a little bit in doubt. So the market reacted. Interest rates went up about 25 to 30 basis points in rate. And everybody who was predicting hold on for the next cut, hold on for the drop, suddenly had a lot of egg on their face. So the market always moves at a minimum, probably 6 weeks in front of the Fed, more likely 2 to 3 months. So just always beware. The Fed meetings are usually spaced 5 to 6 months apart from 5 to 6 weeks apart from one another. So you just got to be really, really careful when you advise people to float. Personally, I don't think the juice is worth the squeeze. And if the market does rally and your interest rate goes down, because again, they move inverse to one another, again, you're going to have to call up your secondary department. You're going to say, hey, what was that float down option that we had? And you're going to have to do a little jujitsu and whatnot. But it's a way easier conversation than than the alternative.
Dude, I couldn't agree more. And then on top of that, like the time somebody would spend, babysitting the files with a microscope that may or may
Hmm.
not be accurate. If we spent that same time with our marketing, we can go help even more people. And
That's right.
it's not that we don't take care of the ones that's trusting us with their business. I'm not saying that, right? But I'm
Hmm.
saying is you got to pick like what's the best use of your time and what's likely going to have the best outcome. And for me, it's like, dude, all the time it would take to do that. And still it's a educated guess. It might be a educated, but it's still a guess. It's an educated guess, right? It's an educated
Correct.
guess, right? And
Correct.
I don't care what your track record is, you're going to be wrong sometimes, right? And that's just the way how it works. And it's just
Totally.
like you said, I think the juice isn't worth the squeeze, and I can exert my effort in another area that is a payoff, not just for me making closing more loans, but for the families that I'm helping also help even more families. So anyway,
Well, exactly right. And I know a lot of the people that listen to this podcast are on the higher end of the origination scale, right? They're more likely to do 5 loans a month or 7 loans a month or 9 loans a month as opposed to 1 loan a month or 2 loans a month. And so, from a how do I spend my time point of view, right?
mm,
You don't want to have to get back on the phone and resell that loan,
yeah,
right? Especially after you've done a bunch of work on it. When I was originating, I would want to get that one locked in, literally and figuratively, hand it over to my team, get it to my processor, let him or her get it submitted to underwriting. I know a lot of people on this podcast have loan partners or loan officer assistants or whatever verbiage you use inside of your company, and then go get the next one.
mm,
Because the going to get the next one, that's the task that requires a very high level of talent,
yeah,
right? That's the task where you're truly doing, and I know this is a little bit cliche, but it's a cliche because it's true. That's the task where you're doing $100 an hour work instead of $20 an hour work. Reselling the same loan a second time with the
yeah,
interest rate or cost to close change might be $35 an hour work, but
yeah,
it's not $100 an hour work.
yeah,
So, bank that one, lock it in literally and figuratively, and then go get the next one, and then go get the next one, and minimize your time after you have that one locked in and banked.
yeah,
And, it's just it's really, and if you do predict the market going down and you are right, yes, that is a good experience. But again, I highly doubt someone's going to be, walking out of church on Sunday or waiting for their kid to come out of kindergarten at the school where the moms and dads pick them up and turn and say to a fellow parent, fellow parishioner, cousin, brother, coworker, and say, that
mm,
damn Carl White is so smart. He told me to hold off on locking when I wanted to lock, and I saved another $2,300. I just don't think that comment's coming. When you look at all the angles of it, all the emotional hand grenades that are along the way, I just think the benefits are far outweighed by the risks.
yeah. I'd say there's a much higher likelihood of a conversation being had if I float and rates go up.
Yes.
There's a exponentially more likely of a conversation at the school bus stop. Let me tell you how this guy screwed me, kind of thing. Like really.
Well, what's that? I can't remember. I'm gonna get the what's that? Bad news travels 10 times faster than good news,
Oh, for
or something
sure.
like that.
Yeah,
People are ten
and
times
ten
more likely to bitch about something than they
and
are to give a compliment.
and 10 times louder. So good stuff. All right, man. Hey, I know
Yep.
this topic had been coming up a lot, and I know you're the most versed person I know that kind of can evaluate all sides of this equation for the things that you do. So appreciate you being here, Owen. I
Yeah.
appreciate it, man.
Anytime. Anytime. I love being on the podcast. Thank you.
All right, cool. Hey, if you want to hear more from Owen, we have him on typically every Thursday morning on the Loan Officer Breakfast Club. He comes in and does a little segment about an update on the market and what's going on and what's on the horizon. Sometimes talking about what rates are doing on the horizon. Sometimes talking about legislation, but always informative. So go to loanofficerbreakfastclub.com, loanofficerbreakfastclub.com. It's free. We meet there every morning, usually anywhere between 400 and 800 loan officers on a big Zoom meeting. And the only thing we might be missing is you. LoanOfficerBreakfastClub.com. Thanks so much. Owen, appreciate you. And we'll see you on the next episode of Loan Officer Freedom. Thanks again, everybody. Bye bye.